This screencast is looking at Summer 17 question 6 and is a very good example of the more recent applied style questions that the CAP1 finance examiner is going towards in recent exam settings. So if we look at the requirement, it's 16 marks to identify and briefly discuss whether the four objectives have been satisfied. So you're told the four objectives in the question, and clearly show your workings. So I'll let you look at part B. It's a very short element about source of finance, a more narrative style question. But what you look at part A was, and remember this was in Summer 17, it was the least popular question, so it was the optional questions, and it was also the least well answered. So we'll look at the examiner feedback at the end, but the examiner is starting to use these applied style questions. You wouldn't have seen this, or students in Summer 17 wouldn't have seen this style question before, but you'd have seen all the concepts you've been examined on. So what you're asked is, you're told Mulberry Solutions, the annual report has just been released, significant decline in performance, and they're worried about the four key objectives they have. So achieve stable growth of 3% in earnings per share. Share price will grow by 20%. Cost of equity will remain constant. And weighted average cost of debt, as opposed to weighted average cost of capital, will be under 6% in 2017. So what this is really examining is an applied concept of ratios, be it using price earnings, using earnings per share, and your cost of capital, using cost of equity and cost of debt. You wouldn't have seen this before. Usually we're asked a very isolated ratios question, or we're asked a very isolated WACC question, of which cost of equity and cost of debt is part of it. But here it's a lot more applied, that you have to use the information given to figure out what are they asking me to do. And you're told information here about the tax rate, the types of debt you have, and some assumptions you can make to make the calculation straightforward. So what we have to do is we have to go down through each objective. So just make this a bit bigger. Objective 1. And we have to see whether or not they've met the objective. So the first thing is, have they grown earnings per share at 3% over the last 3 years? So 15, 16 and 17. And what caught students out straight away was, we're not given earnings per share. So again, this is the style the examiner's taking now. They're a lot more applied in nature. They'll give you enough information, but you should understand the concepts. You should know the formula for earnings per share, and you should know what you're looking for. Right? But you need to think in the exam and don't panic. So what is earnings per share? EPS is, if you put it in, it's profit after tax, PAT, profit after tax, divided by the number of shares. That's all earnings per share is. Right? So if we know that's what we're looking for, we can actually work back to get it. So again, it's important to understand, expect to see some types of these applied style questions based on examiner feedback. Right? The examiner is not going to reward you just for learning off formulas. They want to see, can you apply your knowledge? For 2017, 2016 and 2015. Right. First thing, can we get profit after tax, which is profit of course after interest and tax, where we have PBIT, otherwise known as operating profit. It's 428, 416 and 409. So we actually have our starting point there. We know what debt we have, we know what interest rate we have, and we know what the tax rate is. So if we have all that information, we should be able to get interest, the expense. We should be able to get profit before tax. We should be able to get tax at 20% and profit after tax. Now I know this looks a bit more straightforward when you're doing it not in an exam setting, but that's what you have to start practicing. You have to look at the past questions, particularly the more applied style ones, and think, well, I know how to get earnings per share, I just don't have all the information. Can I work back to get it? Our interest here, so be careful, we have two types of interest. We have 50,000 at 5% and 200,000 at 8%. So we have 50 at 0.05, which is 2.5, plus 200 at 8, which is 16. So that's 2.5 plus 16 is 18.5. Now I'll just change this slightly to put it in minus. But then all we're doing is using what we have to get our profit before tax, 409,000. 409.5, and our tax rate is told 20%, and we know interest is tax deductible. So it's 20% of 409.5, which is 81, and then profit after tax, which is what we're looking for, is 327.6. So the trickiest thing was, you to figure out, you needed profit after tax. You know you were given PBIT, but you were given enough information to work to PAT, profit after tax. That's what the examiner is testing here. Your ability to think through what you need and how am I going to get it. You're not going to be spoon-fed everything. Not every question is going to be like this, but at least one or two parts will be to test the student's application of the knowledge, not just learning off formula. So just repeat it very briefly for the others. For 2016, you had 50 times 0.05 as before, and 180 times 0.08. So slightly less interest there. And here it was 50 times 0.05 as before, and 160 times 0.08. So it's slightly less debt over the last 2 years. So again, just doing those across, you get 399.1 and 393.7. And again, the beauty of these screencasts are pause it now, work on. See, can you, now you've got a helping hand, see can you finish the question before we go on to the next one. There's no point waiting for me to go through each of them. See can you work ahead. Tax at 20%, which is minus 79.8. And that should be times 0.2 minus 78. So you can only do it to one decimal place if you want. That's fine. There's no need to go to two decimal places in terms of here. So then profit after tax for 2016 is 319 and 2015 is 315 when you round. So just round those to one decimal place to be consistent. Right, so that was your starting point. Is we need profit after tax. And we also need the number of shares. The number of shares. Now, the number of shares is relatively okay here because we know the share capital. We're given in the question. And we know, and just be careful, we know each share is worth €1 each. Therefore, it's 75,000 shares. At €1 each is 75,000. So you have 75 for each. Now, notice I've dropped off the zeros to compare like for like. Because I'm using thousands here in terms of euro figures, so I drop the zeros off the shares, otherwise you'll come to the wrong answer. So our earnings per share then, as per our formula, is 327.6 thousand over 75,000. So it's 4.37, 4.26, and 4.20. So we just do it to one decimal to be consistent. So we now have our earnings per share. We got a profit after tax, we got the number of shares. But that doesn't answer the question, and this is the tricky part. We are asking, did we achieve a stable growth rate of 3% per annum in earnings per share within the 3-year period? So what a lot of students, even if they got that far, they would have said, well, how do I do it over the 3-year period? I know I can get the growth rate by saying it's this year's divided by last year's minus 1. That's the growth rate for 2017. It grew at 2.6%. So it grew at 2.6%. In 2016, it was 4.26 divided by the previous year, minus 1. So it grew at 1.4%. So it grew at 2.6% last year, 1.4% the year before. So we know now it hasn't grown at 3% per annum. But really, the way you should have done that is get the average growth rate. So remember how we do this in dividends, where we get the end period, the average growth rate to the end one, divided by the oldest one, right, which is 1.04. So you have that. You said it's grown at 4% over 2 years. But what you do then is you put that to the power of, in this case, so I put it to the power of 1 over 2. Because it's jumped up 2 slots. So we want to say, well, we know it's 4% in total, but per annum it's grown 2 years. So you put it to the power of a half, or essentially the square root. In this case, we take off 1, is about 2% when you round. So it's 2%, or if you want to round out 1, 2.0%. So on average, the growth rate is 2%. You can't just average those. It doesn't really come back. Now, it does here, just coincidence. The more accurate one is the average growth rate, or what we call the compound average growth rate, is 2%. And that's very similar to how we do dividend growth rate when we did cost of equity. You get the end year, 2017, divided by the start year, and put to the power of 1 over the number of movements. In this case, we had 2 growth periods. Yes, it is 3 years, but it only grew 2 years. So So you get the compound average growth rate there is 2%. Objective 1 not met. And that's all you have to write. We want to get 3% per annum, not 3% over the period, it's per annum. We didn't. We only got 2%. So these are tricky enough. So they are tricky enough. Right, so let's move on to objective 2. Again, if you can, pause the screencast now and look forward. See, can you figure out, can I prove that the share price increased by 20% within the 3-year period? So it's not each year, it's over the 3-year period. Right. So we have 2017, 2016, and 2015. And again, think about it. Try and solve the puzzle yourself now before you get the answer or before you look at the solution. I need to get the share price. I don't have the share price here, but I have some ratio that tells me the relationship between the share price and something else. And that is the PE ratio. So remember, the PE ratio equals the share price divided by earnings per share. So let's take these down so we won't get confused. So I know the PE ratio is the share price divided by earnings per share. I have the PE ratio. I have earnings per share now from objective 1. And remember, even if you have the wrong earnings per share, it's fine. You can use it going forward. You won't be penalized twice. You'll lose marks here, obviously, for getting it wrong. But if you take the wrong figures there and go forward, you'll get full marks as long as you use them correctly. So we can actually get the price here now by saying, if we do it, the price equals, if we work across, the PE ratio times earnings per share. So that's how we do it. So we're just, and that's what the applied style nature is. We're testing your knowledge. Do you know the ratios? Can you work back? Not necessarily always calculating the PE ratio, but using it to figure out what the share price is. Share price in 2017 then was earnings per share, 4.37 times 3.2, which was the PE ratio that year, at the end of the year. So about 13.98. So I'll just see, can I tidy up these to one decimal. In 2016, the earnings per share is 4.26 and the PE ratio was 2.9. So 12.35. So the share price has grown. And finally then in 2015, it's 4.2 times 2.8, which is 11.6. So the growth, what we're interested in is the growth over the full period. We're not saying per annum. Increased by 20% within the 3-year period. So we say this year's divided by the starting point, because we want it over the period, not each year, minus 1. So it's grown by about, and I'll just round it here just to be presented neatly. It's grown by about 18.9%. So objective 2 not met. Because it hasn't grown by 20%, it's only grown by 18.9. So again, another tricky one, understanding your knowledge of PE ratio, earnings per share, and how to back into what the share price will be. So objective 1 and 2 are very good at testing your knowledge of investor ratios, which is earnings per share, PE ratio, and applying that knowledge. The next two now are going to look at cost of capital, in particular cost of equity and cost of debt. So what you're asked here for the cost of equity is, has it remained constant over the 3-year period? Again, try it yourself before you look at the solution. If I'm looking for cost of equity, there's two main ways. So we call it KE. You can either do CAP1 or you can do the dividend discount model. So you can either get cost of equity through CAP1, which probably isn't going to be here, because here we're not told anything about betas, we're not told anything about risk-free rates, we're not told anything about the return on the market. So it's more likely going to be the dividend discount model. So remember, we have this in the formulas. So in your formula sheet that you're given in the exam, we have the dividend discount model. See it here on page 18. Could be page 60, 17, sorry. So here it is. The dividend valuation model, cost of equity, equals D0 times 1 plus G over P0 plus G. So we now know how we're going to get the cost of equity. We know it's not CAP1, we figured that out because we don't have enough inputs. Have we enough inputs here? Do we have the dividend? Do we have the growth rate? Do we have P? Right. Now the other formula, just so you know when we were talking about before, was using this one. The growth and dividends using historic actual, that's the formula we used when we were calculating the growth rates before. You put the dividend, or in this case the share price, today's, over the previous one to the power of, and that is just the number of periods. Right, so it's important you practice that one as well. But today we're looking at this formula, or now, the dividend valuation model with growth. So what I'll do is I'll just snip this one. Hopefully we can put it into Excel, so we have it as we go along. So remember, don't confuse both here. This is where we're looking for P. We're looking for KE here. So I'll just put this here. Hopefully it goes in. And we'll have that to show. So we go back to the question now. But what do we need then? We need a dividend. So can we get the dividend for each year? What else do we need? We need the growth rate. What's the growth rate in dividends? And we need the price. Remember, we have the price already. So you can see these overlap, they build on each other. 13.98, 12.35, 11.76. So don't reinvent the wheel. You have these before from B. That's where they're coming from. And you're told in the question, you may assume any share price calculator or XDiv. So therefore, we don't have to work that out. Happy days. Next thing is we need to calculate the dividend. So how are we going to calculate the dividend? Are we told anything? Well, we know profit before interest and tax. We have profit after tax up here. We've calculated as well. And what we're told is you can assume 80% of profits are reinvested. Again, a very applied style way of telling you what's going on. So that is the retention ratio. So you're told the retention ratio is 80%. So you reinvest 80%. That means the payout ratio is 20% each year. Because remember, what you retain in profits plus what you pay out must be 100%. So of the profits, 20% of them are going to be paid out. So the dividends, in this case, are going to be 20% of your profit after tax. So you see the way it grows each time. They are very tricky. So in this case, your profit after tax was 327.6 times 20%. So your dividend was 65.5. And similar for the other two. I'll just calculate them here just so we're consistent. And I'll show you where they come from. Alright. So what we're saying is for each the profit after tax you calculated, even if they're wrong, you'll still get full marks to use them right. 20% of 315 for 2015 is 63. That's the dividend. But remember, and be careful in your formula, this is D0's dividend per share. So we need DPS, dividend per share. Because these are 65,000 in total, we want DPS. So it's 65 divided by 75. And the same across. So we need the dividend per share because that's how the formula works. So pretty tricky in a question. But again, this is just testing your knowledge of the formulas that you should already know from the ratio section and also the idea of cost of equity. So we have our dividend per share, D0. We have our price. What we don't have is our growth rate. And remember, in cost of equity, you should have studied the growth rate. There's two methods. You can either do one, historical growth rate. If we had dividends, you can use that, right? Or two, so you could have actually done historical growth rate here. That would have been fine. Or what you could have done is G equals B times R. And that's what they're looking for here is our G in this case is going to be the retention ratio, which is B. So B is the 0.8 times R, which is the return on investment. So when in doubt, always ask yourself, why am I told the return on investment? That's going to be used to calculate the growth rate. But again, some students might have used the historical growth rate, and that would have been acceptable as well, because you're given both opportunities. So 0.19, growth rate of 15% in 2017. In 2016, it was 0.8 times 0.14, and 2015, 0.8 times 0.13. So the growth rate is completely different. 11.2%, 10.4. But now we have all we need. We have G. We have dividend per share, which is D0 in the formula. And we have the price per share. So having all those, we can back into what the implied cost of equity is each year. So this was not a nice question. That's why a lot of students didn't do it, but expect to see more applied style questions in the coming papers. So what's the formula? We'll bring it down so it's easy to see. So again, you can just sub them in yourself and see do you get the same one. So for 2017, 2016 and 2015, we're going to calculate the cost of equity equals, so be careful with your formulas here. So I'm going to have to do brackets just to be careful. It's the div 0, which is 0.87, times 1.152, so that's the 15.2%, divided by the price, which is 13.98, and then you add on the growth rate, which is 0.152. So that is tricky. What that formula says is, it's D0, which in this case is the dividend per share, 0.87, times 1 point, the growth rate, 1.152, over the share price, which in this case is 13.98, plus the growth rate. That's the formula. And the cost of equity comes to 22.4%. And I'll just copy across. You can practice yourself. There's no point looking at a complicated formula. We can see there that the cost of equity, something gone wrong here. I've gone wrong. I've used different growth rate here. It's 11.2 and 11.2. So just be careful with your growth rates. Price changes, dividend per share, 18.9, and this is 10.4. So you can just practice that yourself. But what we can see here is objective 3 not met. Objective 3 is not met here because you don't have a constant cost of equity. Now, that was a very tough question for CAP1. I want you to know how to get the cost of equity, not CAP-M dividend discount model here. What that model requires, calculating the dividend, using the concept of retention ratio and your payout ratio, and then being able to calculate the growth rate for dividends. Very tricky question. Right. Now our last objective then is objective 4. And we're not asked for the weighted average cost of capital here. What we are asked for is the weighted average cost of debt. So we have two types of debt. We have redeemable debt and we have irredeemable bonds. And remember, we only asked for 2017. So we laid out similar to a WACC question. We have redeemable debt. We have irredeemable. We need to get the cost of that debt. So cost. We have the value already. We're told redeemable, use the book value of 50 and irredeemable 200. So total debt is 250. And we can get the weight because all we have is use the values. So 50 over 200 50 over 200, 50 over 250 should I say. 20% of that debt, or a fifth of it, is redeemable, and then of course 80% is irredeemable. So we have our weights, all we need now is the cost. Now we know redeemable, when our usual WACC questions is, that involves IRR. But in the question they actually give you the gross redemption yield they calculated for you to save time of 4.6%. And the trick in the question was you need to multiply by 1 minus t because we want the after-tax cost of debt. We don't want the gross cost or the gross yield in terms of bonds. We want the after-tax. So it's 3.68. So a fifth of your debt is financed at 3.68. The irredeemable, we have to do a bit of calculations. So the cost of the debt for irredeemable, I'll call it KID. How we get that is, we get the interest and we divide by the price, which is X interest. We're told in the assumptions, assume the price is trading at 250 above par, and par is 100. And you're told any market value you calculate is X interest. So we know that's X interest. And the interest, if it's 100 at par, will be 8. Because each bond is 8%. So KID will be the price, or the interest divided by the price, which is 7.8%. And remember, we want it after tax, because it is a bond, it is debt, and interest on debt is tax deductible. So it's 7.8 times 1 minus the tax rate. So that was pretty tricky, but it's all concepts you would have known from your WACC calculations. It's just asked slightly differently, which again threw a lot of students that year. So it's all about practice and not panicking on the day. So now what we say is 20% of our debt is financed at 3.68%, and 80% or 4/5 of our debt is financed at 6.2. So having both of those weights, we add them up and we say our weighted average cost of debt is 5.7. Much the same as we do WACC, other than we leave out the equity here. So our objective 4 is met. So remember, get your marks, get your conclusion, that they wanted the weighted average debt under 6%, and it is. Right, so as a whole, that question was very tricky. 16% of your paper, it was an optional one, but as the examiner says in the feedback, so always look at the examiner reports, least popular question in section B and least well answered. So some students had a good knowledge of concepts, struggled with the calculations. And the examiner did acknowledge this was not a question in the exact style we've seen before, but it covered the key concepts, earnings per share, PE ratio, cost of debt, cost of equity, that you should have been comfortable with. And the very important last part is, it is important that candidates can apply their knowledge even if a question takes a slightly different format. That's a good guidance, as this examiner will be looking at these style questions again. And look at your notes and our sessions in class where I talked about other applied style questions, that you can see the style of this examiner. So this question was looking at Summer 17 question 6, focused on ratios and cost of capital.